Hold. All right, it is 4:05. Thank you so much for everyone being on the call on a Friday afternoon. Don't know why I scheduled it on a Friday afternoon and lesson learn, but I appreciate you all being here. This is a resource for our amazing donor, for our community. Thank you, New York Life, for being here, for Radiant Health Center's amazing community. This is being recorded for those who are going to be watching it for later. So my name is Michael Lara. I'm the grants manager and individual giving specialist here at Radiant Health Centers. We were founded back in 1986. We are celebrating 40 years serving our community with our primary care, amazing wraparound services, with including food pantry, including behavioral health, as you all know. So I'm going to pass it to my colleague, my executive development communication officer, Aaron Rivera Cortez. Unfortunately, who could not be here today, but he has recorded a pre-recorded video for you all. So I'm going to share that real quick, and then I'll pass over to New York Live.
I'm Edwin Rivera Cortez, Chief Development and Communications Officer at Radiant Health Centers. Although I wish I could be with you live today, I didn't want this important workshop to begin without taking a moment to personally welcome you and thank you for being here. First, thank you for choosing to invest your time in learning. One of Radiant's commitments is not only to provide compassionate care for our community, but also to provide meaningful educational opportunities that empower our supporters with knowledge and resources that can benefit them and the people they love. Today's workshop is part of that commitment. Whether you're just beginning to explore charitable giving or you've been supporting organizations for many years, understanding the financial tools available to you can help you make informed decisions that reflect your values, support your family, and create a lasting legacy. I'm especially grateful to our partners at New York Life for sharing their expertise with us today. Thank you for investing your time and knowledge to help educate our community. Partnerships like this allow us to offer valuable resources that extend beyond healthcare and strengthen the communities we serve. I also want to recognize one of our own team members, Michael Lara, whose vision, leadership, and hard work helped make this educational series possible. Michael has been instrumental in bringing this partnership together, and we're incredibly grateful for his commitment to serving our supporters in new and meaningful ways. As Radiant celebrates 40 years of compassionate care for all, we're also looking toward the future. The generosity of individuals who believe in our mission has allowed us to provide life-changing HIV care, medical services, behavioral health support, food assistance, housing services, prevention programs, and so much more. Perhaps today's workshop will introduce you to a giving strategy you hadn't considered before. If it does, I hope you'll think of Radiant as one of the organizations that can help turn your generosity into lasting impact for generations to come. Thank you again for joining us today. I hope you find this workshop informative, inspiring, and valuable. Enjoy the presentation, and thank you for being part of the Radiant family.
Wow.
Wow, indeed. I did not watch the whole thing yet. That's awesome. With that being said, New York Life, thank you for being here. I pass it to you all.
Yeah, I'll lead the introduction. So, hi, my name is Don. I am from the Orange Coast office in Irvine. I'm joined today by Sarah. She's also from our office. We have Joanna here representing from the Inland Empire office, and we have Angela, our corporate vice president and advanced planning consultant with New York Life, who will be leading the presentation today. First of all, we want to say thank you for being here and this partnership that we're looking forward to doing a lot of things together. In our work, we often see individual, families, business owners struggling with retirement planning, wealth building, charitable giving, legacy planning, and really just have a strategy to align all that properly. Today's discussion is designed to bring clarity. So we're fortunate to have Angela with us today. Angela is our corporate vice president and an advanced planning consultant with New York Life. She has spent 20 years helping individual, family, business owner with charitable giving, estate planning, legacy planning. She's also an attorney and a CPA. So she brings a very unique depth of knowledge and experience to this conversation. With that being said, this is Angela.
Hey everyone, I'm just going to take a quick second here to share my screen. So I hope you all can see my screen. Great.
Yes.
Okay, so what a beautiful introduction, and very inspired by the work that was outlined earlier. This is a key area to my heart about charitable giving. Unfortunately, over the last 20, now almost 30 years of being in this world of tax and estate planning, over time, we've just seen a bit of decreased legal support from the tax system. And this was really evident in the most recent tax law passed last July, where they did put some bumpers on the actual tax deduction of a charitable gift. So when we have these kind of tax changes, and tax law changes every 4 to 6 to 8 years, so we wouldn't expect this to stay. But what we do to pivot and to add flexibility to mitigate the loss of charitable giving is look at ways we can leverage charitable gifts. And whenever we look at charitable giving, we really look at, is there an opportunity to benefit all the parties involved, the person giving, the organization receiving, and then the ultimate recipient of that gift. So today we're going to talk about some of those strategies. So today, even though I am a licensed attorney and CPA, I'm not giving tax or legal advice. This really is only for educational purposes, but we are always available for follow-up questions. So what I'm going to talk about today is, why would someone consider giving a charitable gift? And as I mentioned, there are current tax laws that give you a tax benefit for giving charitably. And so it's one of the few strategies in the world where I, as the person giving, can actually receive a tax benefit, and the person receiving it receives a charitable gift. We're going to go over some of the basics and the types of gifts, and really how we have the options of giving. And I always like to just kind of lay the straight out here is, you can give during lifetime or you can give at death. And both have their pros and cons. There are MRIs now that actually show benefit in your brain for giving. So that's a big incentive to give today. There is some true health benefits of seeing a gift that you give. There are also benefits at giving at death. And oftentimes in our world, when we're looking at hopefully supporting more of a long-term vision or an endowment type plan for an organization, oftentimes an insurance product can give exponentially the amount of gift. And that really is one of those big benefits of giving at death. So reasons for giving, I think we all know these. Really, they are just true to the mission that was outlined earlier. Now, the types of gifts, the types of charities you can give to are public and private. And today we're talking about public charities. I would just say, just as a side note, kind of as a lawyer note, there are many charities out there that profess to be charitable organizations but aren't IRS recognized. So I do love this opportunity where we know that where our gift is going is a true recognized Internal Revenue Code charity. And that is something that's really crucial for when you're giving, because not only do you want your gifts to go to the intended mission of that, but also your tax deduction can be considered invalid. So it is something that you want to be aware of. And then we'll talk about ways of actually gifting to them. Now, if you're giving during lifetime, you can certainly give cash. You can give cash equivalents, and then maybe even a capital asset. And those are something like a stock or a bond, or even property you can give. And so those are the types of gifts. So a lot of times you have to work with the organization to see if they can receive it. And sometimes we do a tax calculation to say, well, if I give it in cash versus it's giving it in stock, how does that benefit us? Where does the tax land and where's the deduction? And then there are gifts that are called split interest or divided gifts. And these are really important because this is important for the donor who genuinely wants to give, but they also need their own income. And so there's often ways that we can do what's called a split gift or undivided gift, or divided gift. And a lot of those do require legal trust to be drafted, but we'll talk about those in a bit. When I was working as a CPA, I did a lot of those trust returns. So it is a very common strategy. And then, of course, today or in the future is also a type of decision you're going to have whenever you're charitable giving. I will just say, for a side note, today I received several emails from past nonprofits that we've supported. My daughter has a brain tumor, so we worked a lot in that world. And they do these kind of pledging campaigns, and they have kind of timelines where they get matches. And so for me, that's one great way to leverage my gift. So I loved those kind of like very pointed times of giving, because if I gave, it doubled the gift. And so that's something about leveraging. Life insurance can sometimes leverage a gift 10, 15, 20 times my gift. And so it's always a matter of how does the gift impact me personally, and then what does it actually give to the nonprofit I'm supporting. So in the tax world, charitable deductions are not always 100% deductible. They are deductible if you give the gift. It must be a completed gift. So what that means is, I'll give it to you, but I want something in exchange. So that would not be considered a completed gift. Now, most of us are not doing that. Most of us are giving. We understand that it's giving without contingencies, no strings attached, and it can be used for the purpose of the nonprofit mission. There are IRS limits even beyond that. So right now, under current law, you can give up to 60% of your AGI, which stands for adjusted gross income, when you're making the donation to a public charity. Now that drops to 30% of your adjusted gross income. That's just how much you make minus a few deductions on your 1040. So if you're a W-2 employee, it's your total paychecks for the year. You might have to add some interest. You might get a deduction for a contribution to a qualified plan. And then the net result is called your adjusted gross income. For appreciated property, that is limited. Your gift is limited at 30%. So if I make $100,000 a year adjusted gross income, and I want to give $60,000 to the nonprofit, I can do that. If I give $80,000, that difference of $20,000 has to be carried forward. That means I can take it on my next year's tax return. You can carry forward a deduction for 5 years. So these are just the limits. And the reason is the IRS wants some tax revenue. They didn't want all the money going to nonprofits. Although if I was running the tax system, I would say all tax money should go to charitable nonprofits. But the IRS does have its own set of bills that they have to pay. Now, there's also, as I mentioned earlier, the private charity. Private charities are generally maybe a private foundation. So like Steve Jobs had a private foundation. That's a private charity. And because there's a potential for self-dealing or conflict of interest, the IRS does limit that gift. So charitable deductions, as I mentioned, that exceed those amounts can be carried forward up to 5 years. So your tax account will keep track of that. So there is some win, however, to bunch charitable contributions. So for example, just say I have a big tax year and I'm like, I want to give away this property this year because it's appreciating so quickly that if I sell it, I have a very large capital gain. I'm going to donate the property this year. I cannot deduct the full donation, but I can carry it forward for 5 years. That's called bunching your charitable deductions. Now in 2020, we had this idea where if you did not itemize, so when you do your 1040, your tax return, you have two options. You can take what's called the standard deduction. So your income minus your standard deduction is your taxable income. Or you can take your income and then itemize your deduction. So if you have more deductions over the standard deduction, you would itemize. A charitable deduction is an itemized deduction. So to really have the win of a charitable deduction, you're itemizing. So other itemized deductions are mortgage interest or state income tax. So in California, for large earners, generally we're itemizing because if we have mortgage interest and we're paying California income tax, we're over the standard deduction. In fact, in July of last year, we had a little win in California because the federal law now allows you to deduct up to itemize up to 40,000 of state and local income tax. Last year it was 10. So what that means is we're getting a little more itemized deduction, which the more you itemize, the less taxable income you have. That's why charitable deductions, donations are so helpful on our taxes. Because if we itemize a charitable donation, we have net less taxable income. So that's really kind of the win from the person giving. So as I mentioned, there are different ways of giving. You can give outright gifts. So I write a check, or today I think I did press the button and made a donation that's coming, I think, out of one of my accounts. So I can do that. Another way to give that I really like is designating the nonprofit as a beneficiary of your qualified account. So this would be your 401k or your IRA. And sometimes it can be a contingent beneficiary. So oftentimes I see elderly persons who have qualified money that they're not going to spend, and they may be the last one of their family. They don't really have a beneficiary. That would be a great opportunity for that charity to be named as beneficiary. And if that person's estate was in any type of a taxable situation, that designation would create a charitable deduction on their final income tax return or their estate tax return. So again, it's still beneficial for that person to name the charity as a beneficiary. And then certainly as a contingent beneficiary. So there are times when you lived as long as I have where persons outlive their beneficiaries and the original beneficiary on that designation isn't alive at that donor's death. So then it goes to the contingent beneficiary. Now, from the charitable's perspective, they love this because oftentimes there are surprise gifts that they get. It's a little challenging to budget on these, but it is something to make sure that the money isn't dispersed according to probate law or to heirs that you truly have already given to. So it's a way to direct your legacy to a charitable that lines up with your mission and the purpose. Another way to give is what's called qualified charitable distributions from your IRA or your qualified plan. So this allows you to give direct from your qualified plan to a charity. Now, there's a lot of income tax win to do this. If you're over 70 and a half, you can direct your qualified plan to give directly to the nonprofit. And the nice thing about that is you don't have to then take what's called a required minimum distribution. So if you're 73 right now, you do have to take money out of your qualified plan, but that direction directly to the charity meets that requirement. So if I give 100,000 directly from my IRA to the charity, I do not have to take money out of my required minimum distribution. I have no income to report on my 1040 for that required minimum distribution. So it saves me income tax. And the charity gets the full amount. Now, I don't also get a charitable deduction, but when you're looking at income tax savings, it can be considerable. For many of us, over the years, we were told by our CPAs, save, save, save to your qualified plan. Save, save, save. And the reason was the more you saved in your qualified plan, the less income you reported because qualified plan money is not counted in your taxable income during your working years. However, the IRS said, okay, at some point you do have to pay income tax. That's what the required minimum distribution is. Now, the IRS said, we'll give you an option. You have to take the money out and recognize it in income, or you can give it directly to the charity. It meets your required minimum distribution, and you get to give a charitable gift. You don't get a charitable deduction, but many times we can do the math. It's far better to give a direct qualified charitable. Also, if your family inherits a qualified plan, under the current law, which is called Secure Act 2.0, if you have what's called a non-eligible beneficiary, typically an adult child, and you leave them your qualified plan, now under the Secure Act 2.0, unfortunately, they have to take that money out in 10 years. So what we're doing by leaving these large qualified plan monies that we haven't spent, we're creating income tax to our adult children. I just talked to a family. They are very successful. They just retired in April, and their son, they're very proud of their son. He is a doctor and he makes over $500,000 a year. So he politely told his parents to gift their qualified money to charity because he's already at the maximum income tax brackets and does not need their money. So for them to give now, they're getting the health benefits and the recognition of giving today. So it really, for that family, what a wonderful option under the Internal Revenue Code. The gift of life insurance is very common in our world. So in our world at New York Life, oftentimes we will review with our clients and prospects who are the beneficiaries of your life insurance. And sometimes without being reminded, we fail to do that. And oftentimes we'll get along in years and the original beneficiary predeceased us, or we don't want to leave it to that beneficiary anymore, and we really need to update that beneficiary designation. That's a perfect time to say, would I like to give the death benefit at my passing to the charity? And we love that idea because it can be a very, as I mentioned, a very leveraged gift. So if I have life insurance and I paid maybe $25,000 for 10 years, so I put in $250,000, but the death benefits $1 million or more, what an excellent gift. And my final income tax return will still get the charitable deduction. So it's always good to review your beneficiary. That's one value that New York Life does do. Will complimentary review your beneficiary designations. And I will tell you, as a lawyer, we do want these up to date because once you die, it's too late to change them, and the beneficiaries can't change them. So we've had situations where the family gets in great dispute because they don't believe that that beneficiary designation was really what was intended. In fact, the number one growing litigation in California right now is sibling dispute. So we want to make sure that all our beneficiary designations, not only on our life insurance, but our qualified plans, are up to date. Also, another opportunity to put a contingent beneficiary as a charitable. So if our children predecease us, then ultimately we can leave it to the charity. I did have an aunt, she lived till 90, almost 99, and she outlived all her children and her husband. So she left her money to her charity of choice. The split interest gifts are a bit more complicated, but they've been around for many, many years. I did tax returns for a very large accounting firm, and we did these tax returns. But a split interest gift, as I mentioned earlier, says, yes, I want to give to you, but not until I take income first. I will give you what's left, or vice versa. I'm going to let you take income until a certain period of time, then I would like the remainder to go to my kids. So it allows kind of have your cake and eat it too. And depending how you set it up, you can have a tax deduction today or a tax deduction in the future. Now, I always like to look at these all the way through, beginning to end, because a lot of times when you're talking to your family about setting one of these strategies up. Say you leave the remainder of the gift to a charity. A lot of times there's room to add life insurance on your life, so you're not inadvertently disinheriting your family. And a lot of times, not only can we give to charity, but we can give even far more to our family when we execute these strategies. So it is something to look at overall when you're deciding. And then just really to replace the value of the estate. So 10 advantages: transfer an existing policy to charity. That is changing ownership of a policy that your family does not need any longer. So for example, I have a policy, Angela, I am the owner, I am the insured, and say I left my spouse the beneficiary, and my spouse predeceases me, so I don't need the life insurance for my family anymore. I can work with the charity and say, I'd like to change the ownership to you. Can you administer this life insurance policy? Yes, with the help of Don and Joanna, we can do that. So I go to my insurance carrier agent and I say, change ownership to the charity and change the beneficiary. Now that is a gift from me to the charity, and that gift is valued at the fair market value of the policy on the day I die. So say my policy is $10 million death benefit. It has cash component of $100,000. That means when I change ownership of that policy to the charity, I made a charitable gift of $100,000. So that means I get to deduct that, and then the charity owns it. So when I die, the 10 million goes to the charity, no taxes. It's a beautiful way to give gifts. Again, you would capture this with ongoing, at least annual reviews of your overall financial situation. Designate the charity as a policy beneficiary. We mentioned that. Make a cash donation to the charity, who then purchases a policy. So we just did this in Arizona, and it was one of my favorite strategies I've worked on. So we had a wonderful lady, single lady, no children. She has been giving to a humane society, a dog shelter in Arizona, for the last 10, almost 12 years, she said now, and she volunteers there every week. And she was giving money, and she thought, is there a bigger way for me to give? And so we talked to the head of the charitable donations, the officer there, and they agreed to use her charitable donation each year, a portion of that, to buy life insurance on her. And because she was a donor and she volunteered there, the charity had insurable interest to allow them to do that. So now when she passes, they're going to get a gift of almost $2 million. So they actually have already done plans for an expansion. She has a plaque on the wall, and she knows that even past her, the great work of the charity will continue. And I think that is just really a win-win. I love that so much. We've talked to many other charities about that. And I know that if you're interested in that we certainly can help facilitate those discussions, because I do think with the concern of the tax law impact, what we want to do is, yes, make sure the donations are great for today, that our current work can continue, but that our work past any individual donor can continue. And that just makes more stability for the nonprofit, more stability for the recipients of the charitable work. Okay, your gift may be maximized. As I mentioned, continue to give outright. Life insurance does give a leverage. And what I mean by leverage there is, if I give a certain premium amount, we can illustrate to you what that will turn into at your death. So exponentially, the gift gets larger. Okay, and that again just allows our legacy to live on. We have great satisfaction for helping for worthwhile causes. I did hear someone say the other day that no one can tell us with certainty where our tax dollars go. So if I pay $1 of income tax, there isn't anyone that can follow that dollar to see that it landed in helping a mental health nonprofit with a government grant. No one can tell me that. But if I give to a charity and I get the tax deduction, I know where my money went. I have certainty on where my dollars were directed. And that does really give a lot of satisfaction, especially if we are leaving as part of our estate plan. So life insurance can provide much more for the charity. It can endow a chair. It can create a scholarship. It can continue payments even past our life. So the personal asset, your personal assets can also remain intact. There's no significant invasion of capital. Your family will not suffer. You can fund these without taking away from your family. And that's why you want to work with an advisor and with the development officer, because what we want to do is make sure that it is a true charitable gift and that we're not taking away from you. And that is really the benefit of these type of leveraged gifts. So a gift of insurance is not subject to delay or probate. Insurance is just easy. It gives. There are other vehicles for gifting, and I'll talk about that in a moment. But as I mentioned, annual gifts paid to insurance can go to a qualified charity. The deduction can reduce the cost of the insurance gift. And if we do give it to charitable organizations that are qualified, then we can get the deduction. So your charitable gift will pass free of taxes, no income tax at death. Life insurance proceeds are paid. They do not increase your taxable estate. The charity would own the gift in this example, and or you could own it. So life insurance has several components. We would go over that in great detail with you. The policy builds cash value while you're alive. The cash value can be used by the charity during your life if they own it. And then access to that can be income tax free. So also what we want to do is decide, I don't want to be recognized for my gift. I prefer to keep it confidential. We can work with that, or you can choose to be recognized for your gift. We give to several pediatric brain tumor foundations because my daughter had a brain tumor. Some I give with my name and some I give without my name. And so I do like the choice on that. Okay. So New York Life, we'll go about that in a little bit, but New York Life has been around for many, many years, and we just have a real handle on this type of gifting, and just really the leverage of that. But again, as I mentioned earlier, you can give gifts of stock, you can give gifts of real estate, you can give gifts of life insurance. So I'm just going to talk a little bit about that. I just want to check our timing. A little bit about the split interest gifts that I mentioned earlier. Those gifts that, yes, I do want to give to you, but I may need income for my life. So a split interest gift does include what's called a trust or an annuity, some type of legal agreement that says, I want to give to you, but please know I need income for life, or vice versa. So a charitable remainder trust, there's two types. There's called a GRAT and a CRUT. And each of these are trusts that are drafted by an attorney, and they are in agreement with you and the charity. And in the CRAT, charitable remainder annuity trust, it says, dear charity, I'm giving my real estate or my stocks to a trust, and the trust is going to own it. And because you're the beneficiary of that trust, I get a charitable deduction of what you will get projected on assumptions at my end of life or term of years. So you're welcome. Now, before that, I'm going to keep an annuity stream either for my life or my joint life if I'm married, or a certain number of years. So yes, I want to give the property to you. I want to avoid the capital gain. So I'm putting it in the trust now. The trust will sell it. They do not pay income tax or capital gain tax. So when I take my stream of income back, that's when I will recognize my capital gain, but it'll be stretched out. So there's real tax advantage for me to do that. But in order to get that tax advantage, I have to give the remainder to the charity, you. So at the end of my life, or it could be a term of years, I've seen some of these at 10 years or at 20 years, you get whatever's left over. And I think that's a win-win. Now, my kids may say, but we thought we were going to get what's left over after you had income. Mom and Dad, I'm not sure I like this idea. Well, that's when we would look at, well, yes, kids, but remember, I'm taking a stream of income during my lifetime back. I will dedicate a portion of that income to buy life insurance on me. So when I die, you kids avoid a capital gain because I'm giving you life insurance instead. Life insurance goes to my children income tax free, unless you live in a state that has an inheritance tax. Very few states in the US do. California does not. But kids, you will get way more by this strategy. So it's a win. I got to slow down the recognition of my capital gain. The charity gets the remainder, which will be substantial, especially if I die tomorrow, they get everything in there. And kids, don't worry, I'm not disinheriting you. You will come out even better because you're going to have the leverage of life insurance. Now, in a charitable remainder annuity trust, I will take the same income every year. So that helps me decide my budget. There's also the option, which is called the CRUT, Charitable Remainder Unit Trust, that says every year we're going to look at what's in the trust, and based on my life expectancy, I'm going to take out a dollar amount. So I have enough income. This is extra. So I'm okay with variable gift. So that is just how you would decide to set it up at the beginning. Now, this is a great idea, but the charity does have to wait for the gift. So there's also the reverse, which is called a CLAT or a CLUT, Charitable Lead Annuity Trust or a Charitable Lead Unit Trust. And that just flips it. That says, I put my property in this charitable trust, dear charity. You can take income out for my life, but at the end of my life, the remainder goes to my children. So you still get a charitable deduction up front. The charity gets to take income, but I'm not giving the full caboodle away. My children will get the remainder. And we do a tax calculation on what that's estimated to be. So your children still will get their inheritance. It's just the charity will get the upfront stream of income. There are other ways to give called pooled income funds. I think these are a little bit more tricky. What I like is what's called a donor advised fund. A donor advised fund is very simple to set up. New York Life has access to help you set these up. Fidelity is a big sponsor of donor advised funds. There's other sponsors. But how a donor advised fund works is I set up an account in my name at the sponsor and I put, say, 100,000 in there. Well, I get to deduct that 100,000 up to those adjusted gross limits on my 1040 in the year I put the money in. But I'm not sure where I want that money to go. So the sponsor takes the 100,000, they manage it, and from time to time they're going to ask me, do you have any recommendations where we should gift the 100,000 to, or a portion of it to? Do you have any recommendations? I'm like, oh, I really want to give it Radiant Health. And they're like, okay, we'll take a look at it. I can't mandate that they give it to a specific charity, but I can recommend where it goes. Now, I can recommend it every month. I can recommend it once a year. I can decide on if there's a giving campaign, I could write my sponsor and say, please give to this organization. They have a giving campaign. And they will take that under consideration. Now, my understanding is the donor advised fund sponsored by Fidelity, they do require at least every 2 years you give a recommendation. So you're not just leaving money in there. The IRS certainly wants that money to come out to the charities. So even now there's current legislation being considered that says you have to push that money out in 15 years. There isn't that current law, but watch, it's coming down the pipeline. The nice thing about those donor advised funds is you get an immediate income tax deduction and you get to recommend where it goes. And there was a court case recently that said that the people were mandating that, or the sponsor was just rubber stamping that gift, and they did get a little IRS ding for that. So please don't go in with the expectation that you would have that full control, because unfortunately you do not. There are also charitable gift annuities. For New York Life does not sponsor these, but there are ways to have the charity own a gift annuity on you. That is a great way to give charitable gifts. And then we would just have to work with the charity to see if that's an option with them. So we talked about this, so I'm not going to stay too long on this. This is, again, is the charitable remainder unit trust, where you give an asset. Typically, it's a capital asset that you don't want to recognize a capital gain on. So it's a building. It could be a large stock portfolio. I've seen sometimes where they give like antiques or coins, and then the charity sells them, because the charitable trust does not recognize capital gains, as I mentioned. So it's a way that I slow the recognition. Now, I will just say a side note. I know it feels like we're paying a lot of taxes, but historically, we're at a pretty low tax environment. Capital gains rate right now is max 23.8. That's historically low. There were many years where that tax rate was the same as our marginal rate. So that would make it up to 37%. So again, working with someone like New York Life, an advisor, in conjunction with the charity, we would have a projection of what the tax law is going to do. So that can allow your timing of your tax deductions. So we talked through this on the rules of CRAT and CRUT, typically an appreciated asset. Again, the donor would just give the asset to the charitable remainder trust. That does have to be drafted by an attorney. And these charitable remainder trusts do have to do a tax return. So it isn't for the lighthearted. It's not for someone who wants to give and be done. This is someone who has a very methodical, intentional philanthropic plan, that they have a good accountant that can do the tax returns. But it can be a great way for you to both win and give. So the annuity would be based on your life expectancy, or joint if you're married, or if you're going to do it with a child, it can be a joint life. And then part of that annuity would be recognition of the capital gain over time. But the big benefit is the charitable organization. As I mentioned, we give a calculation about what they would be expected to receive. So who's the winners? I love this. We're the winners. The charity's the winner. The IRS may lose. Very seldom do they lose. The heirs, they would lose, but we would always replace the asset with another asset or charity. Okay, so Secure Act creates even new incentives. This is the act I mentioned earlier that right now, and it's relatively new in tax world. It's only a couple years old now. It does say if you leave a qualified plan to a beneficiary that's not accepted under the Secure Act. So this doesn't apply to a spouse, to a minor child, a disabled child, or chronic ill child. They would not be under the 10-year rule. But in the doctor example I gave earlier, they are 65 and their son is 32. And he's going to inherit I think it was a $6 million qualified plan. And I said, he's not inheriting a $6 million qualified plan. He's probably inheriting a $5 million or $3 million. Half will go to taxes. So again, we want to look at, maybe I should pull money out of this or give directly out of this qualified plan to the charity, and just see if I can just really give and minimize the taxes. This is really a 2-generation plan, but what it does is it often creates a legacy for the 3rd generation. So when we do these strategies, we stretch our giving not only to the charity, but down to our grandkids and great grandkids. So again, a win-win. So this is just the client would give the IRA at death to a charitable remainder trust. The annual distributions would go to the kids and then to the charity. So you do want to talk to the charity, because I tell people you don't want to take away their bread and butter money and where they can't turn on the lights. These are strategies typically for where you want to give more than you are, or they have their monthly bills paid, and they're really looking at long-term health of the organization. So this is really just a way to really leverage this. So there are other ways we can get really complicated in the actual advancement of this. And if you look at large estate plans, they all include charitable planning. And I tell people it's not just because the people are charitable, it's because there's tax benefit to that. So my daughter actually knows Steve Jobs' children, and she's talked to them many times. And he did give his fortune to a private foundation to get the charitable deduction, but the kids work there. So he changed their inheritance to a salary. And so I do see families doing this sometimes when they're concerned about giving too much money to their children. So instead of giving it outright, they may give it to an organization that then the kids can work at. And this is kind of to avoid them just getting money outright and not being productive citizens. So this is especially important if there's a nonprofit or a charity that's close to a family's heart. And I remember I grew up in a very small town in South Dakota, and my dad, we didn't have much money, but my dad always gave to the Salvation Army. And when I was in college, I just asked, why do you do that, Dad? Like, why do you always give? Like, don't you want a new car? Like, I couldn't understand. And he said, I always choke up a little bit. They had given my grandma money when she needed it. So this is the benefit of really leveraging these gifts. Sorry, and the story will never get old to me. Okay, so back to this. So we talked about the charitable lead gifts. This is, again, just flipping, where the charity does need the bread and butter money. They need the money today, but I'm willing to do that, but only to make sure that my kids get the remainder. And that's called the charitable lead trust. They are going to lead by giving the charitable deduction, but not disinherit the kids at the end. Okay, so we just go through the diagram here. It gets a little complicated, but we can always be around for questions after that. We talked about pooled income funds. We're just pooling money together to give a bigger gift on the pooled income funds. I personally like the donor advised funds a little better because I think there's less administrative costs, because oftentimes you do have to look at, okay, if I execute some of these strategies, is there a bleed out to administrative costs? So I walk in all the walks for charity, the Susan Goldman, all the brain tumor ones, but a lot of those have heavy administrative costs. So some of the power of my gift gets lost. The donor advised funds are very affordable. They're easy ways to give. Not that we shouldn't do the 5K walks or the 10K walk, but a lot of times we avoid some of the administrative drag on this. So there are very many strategies available to you, and it really comes down to your own family and your goal of giving. And we're here to help support that, facilitate that, because our hope is that Radiant Health has many donors and that they give in the biggest way. And that really keeps the health of the organization, not only for your lifetime, but for many lifetimes past you. Okay, so I did speak quite a bit of time here. I'm just going to stop share and see if there's any questions, or I'll turn it back over to you, Michael or Don.
Wow, that was amazing, Angela. That was amazing insights, resource. I learned a lot myself, and I appreciate your time and your heart that went into it. I felt your heart was going in through the presentation. I'll open up for the floor, and Arno, Edith, and Sue. As anyone, you're not required. Just you guys have questions for Angela as we have her on the call. She's also welcome to reach out afterwards, right? We can send Joanna's Don's email as well.
Yes.
Questions? You did put in the chat. Thank you for very informative.
Just add for charitable deductions on your 1040, you do have a calendar year. So it's January 1st to December 31st. So that would be at the 2026. So, I just mentioned that because I've seen people like January 1st say, oh, I'd like to give a charitable deduction. Well, contribution, well, that would be for that year. So I do like to say, this kind of mid-year is a good time to look at your overall financial plan for the year. We can pretty much project your income tax by July of what you'll owe in April or what you'll get refunded in April. And then you can do a very methodical, consistent way of giving. So the temptation is to wait till December 31st because you feel certain of your income, but we know by July pretty much what your income tax is going to be and if your withholding's on target. So I do say, this is something that you want to keep in mind when you're looking at a real planned charitable giving. The other thing is when you do charitable giving in a very planned manner, it opens your space in your heart and your budget for other gifts and other opportunities. So if I know I'm giving and I know the charitable deduction for that, maybe I feel better about taking my daughter on vacation because I've met kind of my goal there. And so I do think and encourage everyone, if you're doing family meetings, this is a great time, like in the summer, to have those.
Love it. I see Arnold came off mute. Did you have
Yeah, just a couple questions. Now, my understanding of QCDs is 100,000 per member of a couple that is a marriage.
Per person.
Against your RMD. It's about 100,000, I think, for this year.
Yes, per person. Mm-hmm.
And the other question I have is the we're probably not in the ballpark for family foundations, but I don't know if you mentioned that.
Yeah.
Some of our neighbors have set up family foundations where the kids are employed and so forth.
Yes.
What is sort of the minimum amount of net worth for that?
So they are expensive. So a lot of advisors will say 50 million net worth, but I will say I helped set one up in Arizona, and they were not worth that much, but they had a very specific purpose. This person, and he said I could share the story, is all the koala bears that come into the US go to his farm, his eucalyptus farm in the US. And they go there because they have to teach the koala bears how to eat and to get acclimated. And then they deliver them to the zoos, and then they teach them how to get acclimated to the zoos. And so this is a very precious process of how we get koala bears in the US. And the children were not in the US, and they did not want to come to the US after dad died and run this farm. And so what we did is we moved the farm to a private foundation, and they're going to continue. And the private foundation will have a board of directors, and the board of directors will be the children because they don't have to live in the US for that. So their inheritance is not money. It's going to be, they're going to be on the board of directors and they're going to be paid. And so it was a great way to let the foundation live past this one individual. He did have a key person ready to go and take over that's already helping him. And the reason we got involved is we insured their lives. So there was money to keep the farm going. It's very expensive to run this farm. And so it was a way where even though they weren't at that net worth, it was a perfect answer for that family. We have another family also in Arizona where the dad has antique car collection and the mom has art collection. And the value is all over the board. And I told them that it won't really matter what you think it's worth. The IRS will tell you what it's worth. And it is considerable, but it could be nothing if no one wants the cars. The son already said, if you leave me the cars, I'm selling them. And so we moved those collections to a private foundation. It's going to be a museum. And the museum income will be what the kids get. And so again, that was just one example that we didn't leave the kids money outright, and that family net worth was not that high. It does get expensive to run a private foundation because you have to meet the IRS guidelines. You have to have board of directors meetings, you have to have minutes, because there's the potential of conflict of interest. But those private foundations then could say, okay, Radiant Health, we're going to give part of our donation money that they have to give out every year to Radiant Health. So the private foundations help public nonprofits because they every year have to give out a certain dollar amount, percent of their money. And so you can be recipient of that as a public charity.
And the third question is my last question. We've sort of found out by error because we've started, this is our second year doing QCDs, but we found out it's a very formal
Yes.
process, much
Yes.
more formal than we learned the hard way last year.
Yeah.
We've started it this year. My understanding is you have to link up with a specific charity and have a letter and everything else set up in advance, as opposed to
Well, yes, you want to make sure both parties are working in synergy. The person holding your qualified plan and the charity. Because where this breaks is I've seen qualified plan administrators send the check to the person and then they send it to the charity, and that breaks the qualified, that breaks it. So you want to tell them, and I even looked at the form on this one break, and it specifically said pay direct. But I think that the charity wasn't aware and they didn't understand. So it is something that you just want to talk. It's not complicated once you've had the discussion. It's pretty easy. It's just you make the request to the plan administrator. And remember, it's pretty new. So the first couple of years were quite everyone was confused. And so now administrators have it figured out, and charities really just are recipients of the gift. And so it's much easier, even as far as 2026 than it was. I remember a few years in the beginning, no one really knew what to do or how to do it. The plan administrators didn't even have the way to get it to a public, to a nonprofit. So it will be easier this year.
Yeah, thank you. No, we learned the hard way. It's a very formal process. And the only thing it is, it really puts the pressure on you to really, instead of doing like we used to do, where you have maybe 10 charities, you get to small amounts. You sort of learn the hard way. You got to pull, maybe just do 2 or 3, because each time we're finding we have to meet with our administrator at the swab and then do the donation. But thank you very much. Those were my
Yes.
Sue put it in the chat. Thank you, Arno, for those questions. For DAFs, if you said you can only suggest who you want the funds to go to, what would disqualify a charity other than a non-503c? And what happens to the money if it does not get distributed?
So the plan sponsor will check if it's a qualified charity for you. And so they check. And if you die and the money's not distributed, you name a successor. So if I die, my daughter then becomes the person making the recommendation. So you don't get my daughter doesn't get the money because it's an irrevocable gift, but I name a successor. And so ultimately the money will be paid out over time.
Awesome. Any other questions? Don, Joanna, you want to share anything else?
Thank you, Angela.
Yeah.
Well, thank you so much for attending today's our first ever financial workshop here at Radiant Health Centers. We appreciate everyone's in attendance. We all hope you have an amazing weekend, and thank you for being here.
Thank you. Bye.
Everyone.
Bye, everyone.